Alan, Darby, Jacqueline, Martínez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after. Welcome back, friends and family, and hopefully some new friends to your Buyer's Boardroom. I'm your host, Rick Music, and you can just about tell from my hair today's going to be a good day. We got Jacqueline Martínez and Alan Darby, our Zen masters on everything M&A, and we have part 2 of a 4-part series that we put together for you to make life so easy that's going to differentiate between the different buyer models. Today is episode 2, but as a refresher, brought to you in episode 1 was structural differences between buyers. Today, we're going to talk a little bit about life cycle. Where is that buyer on their journey? Our next episode is going to be the autonomy differences. And then to finish off, we are going to go with expansion capabilities between these buyers. Hi, guys. Alan, what's cooking?
Your hair does look amazing today, I must say.
It's going to be a good day.
It is. It's always a good day when the hair is on point. So congratulations. Okay. Yeah. So and also as a reminder, in this series, we're trying to bring in a representative of kind of each side. So like today, we're going to be talking about life cycle differences. And when we say life cycle differences, we're really talking about where the buyer is on their journey. And if you can think of like 2 broad ends of the spectrum, there are firms that are early in their journey. We use a baseball analogy. They're in the first, second, third inning. So this may be a firm that's somewhere between $1 billion to $5 billion in terms of size. They've done some acquisitions in their past, but not to the extent of some of the larger, more developed firms, which are on the other end of the spectrum. So we have these well-established 100 billion type plus size firms. They probably have done 20 plus acquisitions at a minimum. So they're much more mature. So that firm is obviously at a much different point of their journey than the firm that's just getting started. So that's a broad way we differentiate. One of the 4 ways we differentiate buyers. And so today we're going to talk about the pros and cons of each one, and we're going to focus on 3 main areas. The first would be, what is the access to resources for clients, resources for your team. Second is, what is your seat at the table, so to speak? What's your ability to have meaningful contribution as a partner in this enterprise? And then the final area is equity appreciation. What's the benefit to joining a firm that's early in their life cycle from an ownership perspective versus a firm that's later and more mature? So that's kind of the 3 areas that we're going to focus on today in this life cycle differences.
Well, the Alaris booking agent, again, has been very, very busy. We got another action-packed lineup on our guests today, and we got two hot shots, one by the name of CJ Rendic, and the other is Scott Holsopple. CJ is the CEO of Parallel Advisors, and this is a unique story. They're a San Francisco-based firm managing about $6 billion, but what makes them unique on their journey is they've been crushing it over the last 5 years as far as growth. So I'm interested to hear a little bit more on that. Scott Holsopple is the Chief Growth Officer at Hightower Advisors. Obviously, everybody's heard of Hightower, about $100 billion in AUM. They are a hybrid, and he's going to have, maybe a more of a fully baked RIA story as opposed to the growth. So I'm excited about that. But, before we get into it, guys, we always like to riff a little bit on what's happened this week, and I'd like to lead this off. We've got some big things cooking. Behind the scenes, we don't really tell anybody about this, and it's not really my news to share because I didn't do any of the work. But from a tech standpoint, Alan, holy smoke, you've been busy in the kitchen. Between our website and some of the tech projects that you're working on, is this something we can talk about?
Yeah, we can tease it a little bit right now. So we did a new website, so that's AlarisAcquisitions.com. We think it's super cool and very descriptive of who we are as an organization and our value prop. So check that out. But also, for the first time, we're announcing our Lens application, which will be the first application. Think of it like Match.com for advisors who are considering a partnership. Wherever you are in your journey, you might just be thinking about what it means to partner, considering for the first time, or you may be fully intent on looking at a transaction in the near term. This is going to be the first place that you could go to and get educated on the buyers who's out there, what their models look like. In a purely agnostic, you're not committing to anything. It's the first place to explore buyers and their models in a way that's private. And if you want to, go further, certainly you can engage in the process and get started. But that we're going to be promoting that over the coming weeks and months as we release it. We're doing it internally first, but then we'll turn it on to the public. But we're super excited. We think it's going to be like the Uber equivalent in wealth management specific to M&A.
I think it's dope. I think it's incredibly exciting. Jacqueline, anything crazy happened in your world? And I know it's always crazy in your world, but is there any, and again, the answer can be no, you can get a pass, but we got to ask, what's going on?
Um, yeah, no fun stories this week. It's been a little mellow.
Well, that's a
Yeah,
win
which I'll
because
take it.
usually your fun
Yeah.
stories are,
That's a good thing.
Yeah,
That's
it's
a good
good.
thing.
yeah, that's a really good thing when you've got less to say. And I don't mean that to sound the way that it did. Well, guys, we got a packed dance card today. Why don't we get to it? We broke down, we're categorizing within episode 2 here of how we're going to break it down. Why don't we start with, access to resources? What does that mean to you?
Yeah. So access to resources, it's basically depth of people, expertise. It could be capital. It could be expansion of services. So resources is kind of a generic word for a lot of potential things. And buyers, they usually try to emphasize some of those aspects over others. But if you're speaking about larger firms, so that's the one end of the spectrum here, you would naturally expect that these firms have more stuff in all of these areas. So people, for example, in terms of client experience, it could be advanced estate planning, so they may have a team of people who help you as the advisor solve complex problems around your client issues regarding estate planning. It could be tax preparation. It could be financial planning, their depth of their investment team, so just more people who have expertise. They have professional designations that actually deliver real results for you as an advisor. They make you look better. They showcase it's a bigger organization that makes clients feel comfortable. Capital could be something like, so larger organizations, usually just because their balance sheet is larger and their cash flow is larger, they have more access to capital to deploy into things like acquisition growth, but also internally investing into technology build out, R&D, the client experience, all sorts of things that just because they're larger, they just have more resources to throw at it. And then finally, expansion of services. Think of financial planning and portfolio management as the two bedrock services offered by most firms. What do they do beyond that that make me look more appealing to a broader spectrum of clients? So tax preparation, qualified plan expertise, corporate trustee, banking, mortgage lending, all sorts of, employee benefits. There's this like whole host of things that the larger firms tend to have more of. It's kind of common sense. So when we're categorizing buyers in this access to resources and expertise, those are the particular areas, and we see the larger firms just have more of that stuff.
True. Right. So smaller firms, say that, 1 billion to 10 billion firm, they may have less of all of those things than, say, Hightower level of capital that's available to go do acquisitions or things like that. But we still see a lot of smaller firms that have gotten very specialtied in where they're investing resources and maybe have a really great alternatives lineup and staff dedicated to that, or like the estate planning that you were mentioning. So not to say that smaller firms still can't have a really great offering, still adding talent to be able to take your services to the next level just because they're smaller. It's all about finding, okay, what are you really looking to add when you enter into a partnership, and has this firm dedicated resources in those areas, then that you could still find that with a small firm.
For those of you listening, 1 billion as a small firm, that caught me a little off guard. Is bigger better in this conversation than smaller?
No, not necessarily. I mean, look, it's just common sense that larger firms have more breadth of resources and capabilities. It doesn't necessarily mean they're better at any one specific area. And we've seen it all happen. Big organizations, they grow, and sometimes what was really special and unique about them gets diluted as they expand, And so it's not that doesn't happen all the time, but it's not that bigger is better. It's just, it's more. sometimes, being the smaller firm, the buyer, they're looking to add those areas of expertise and competence. And so that can be, from a seller's perspective, more preferable, because if you're looking, kind of segueing into the next area we're going to talk about, which is having a seat at the table. But if there's a buyer who meets all of your other cultural requirements and needs, and they're looking to add to what will in the future be their expanded resources and capabilities, and you happen to be an expert in that area, that could be a significant opportunity for you. And so bigger is not better. It's just, it really is just, what are you as a seller seeking in terms of the partnership? Is it stepping into an environment where all that stuff is already built and is just plug and play and you can just access that? Or are you comfortable with not having those resources necessarily, or it's a smaller group of people within the organization to draw upon? Or perhaps you can be contributive to that expertise.
So let's move into item 2. Let's keep this list going. But you'd mentioned seat at the table, and we are differentiating models. So staying on book here, seating at the table or the involvement of a seller. What is the fertile ground between our buyer models where maybe that seat at the table is more readily available than the next? Well, I know what it means when I talk to most people. It's I'm gonna make the decisions for you. Like and it's coming from
Right.
it's
Yeah,
a
I
little
hear
bit
you.
tricky.
But Jacqueline, wouldn't you
Yeah.
agree? Like, most people, when they say they want to have a seat at the table, what I hear is, they have substantial impact into the overall direction of and operations of their firm, if not total impact. And when they sell, I'm doing quotations, air quotations there, they're joining another team. In the majority of cases, they're still an owner, as we've talked in previous conversations. They want to know that their voice isn't lost, that they're still going to have contribution, right, Jacqueline? Wouldn't you say?
Right. I mean, and I would say even more specifically, it's about around their how they run their local office, hiring and firing decisions within their specific office, or how they're delivering the experience to their clients. And they know what, they've built their business. They they're open to fresh and innovative ideas, but also, know what would resonate with their clients and wanting to have control over that end deliverable to the client versus making decisions about what technology should we use and bringing on debt and dealing with those things. Maybe they're okay to let go of control of some of those aspects or more of the legal aspects, being on the board, those types of things, but wanting to have a voice in anything that affects the end client.
Exactly. So, and that's where we talk about this as the autonomy profile at Alaris. And so, because when you reference decision making or being a contributor in decision making, we really need to unpack that and break it down. So, like, if you're talking about having a legal vote, or like you are a part of the C-suite, the executive decision making team, um, that's not as available as being a contributor to the overall direction of the organization, and it's certainly not the reality of you being able to control your client experience and decisions. So when you say seat at the table, if you're asking for, be a part of the actual C-suite, or you're asking for an actual vote, in, let's just call them strategic decisions of the overall firm, that's available. There are some buyers. They tend to be on the earlier phases of the life cycle. They're in that $1 to $5, $1 to $10 billion environment where they're still adding to their team. And so if they identify a seller that possesses some unique expertise or skill at that executive level, then they're open to that. We've had buyers that have actually actively told us we're seeking these types of positions, but that's very narrow. It's not as common. Um, what is common is collaboration. So if, for example, let's say that you wanted to get either yourself or someone on your team was a part of your investment committee, maybe your CIO, and they wanted to still be a part of the investment committee decision-making process. Well, there are many buyers who will be eager to have you join their investment committee. Sometimes they have these advisor groups that they put together in different areas of the business that they will appoint you to. And those groups truly do shape the direction of the firm. So the executive team basically says, okay, advisors, coalesce around these specific areas. So planning, investments, maybe high net worth clients, pick a topic. And the advisors or certain advisors, as appointed by the overall group of advisors, will participate in those committees. They will inform the executive team on their opinions or with their needs and what they want to see developed in the future. And the executive team really listens and takes direction from them. Okay. That's very common. And I would say that's the norm, regardless of where you are, the buyer is on their life cycle. They want to have that input from the advisors. Now, client experience, which Jacqueline was pointing to, I find that to be pretty much uniform. Very few buyers want to step in and mandate like what's done on behalf of your clients. They're going to look to you to be the ultimate decision maker for all things that get in front of the client. Now, they may provide resources. That's where the depth of expertise and support comes from, particularly in the larger firms. But you'll still be largely controlling the client recommendations.
hmm
Are there firms that are just not interested in input on client experience? Does that exist?
Yeah, I think so. Going back to our United Capital days, right? So we had FinLife, and that was a very specific client experience. And when I say client experience, it's the steps that you use in the process of onboarding and servicing clients. It's the language you use. It could be technology that undergirds the entire process. There are firms that have an opinion on that. They have developed something internally. It's really cool. They'll be able to give you all the evidence in the world that says this is why you want to adopt this client experience. But I would even say those are in the fewer category. More commonly, they just say, look, if we have a client experience, we'll encourage you to adopt it, but we're not going to interfere with what you do and how you interact with your clients. That's more of an
Yeah, that's common. Or you can pick and choose from it for a given client what's appropriate for them. And but oftentimes to fully experience the centralized operations support of the firm, it may mean adopting more of that to be able to fully get the efficiencies that you're looking for in joining a bigger firm.
Yeah.
Right.
So in summary on this seat at the table, I would say if you're seeking to be at the executive seat at the table, you're automatic, kind of like by default, you're going to be looking for buyers that are on the earlier phases of their life cycle. If by having a seat at the table, you mean you want to have a meaningful contribution and feel like you're a valued, member of the team that they listen to, I find that that's pretty similar regardless of the size.
Mhm.
They want their partners to stay in that entrepreneurial mindset, being willing to contribute to the overall direction of the team. So that's uniform and likely that client experience as well. So the client experience is largely, regardless of the size, is going to be left to you. The difference is how much support is there to actually aid you in your delivery of whatever service along your client experiences. Larger firms tend to have more stuff and support in that regard.
So staying within the thread, we've again through buyer differentiation, if that's a word, we've talked a little bit about access to resources. We've talked about what it means to be a seat at a table within the varying firms and where they are in their life cycle. Why don't we finish with equity and valuation, guys?
Yeah.
Sure. So there are two main drivers of equity appreciation. You of course have your EBITDA, your profit that the earnings multiple is applied to. So when you think about a Hightower type of firm, you know, likely mid 20s on the EBITDA multiple, you would think that might be a market value for a firm like that. And that very well may be the top end of an EBITDA multiple range. Yeah, who knows what the future holds for us. But let's for a moment, maybe that's the top. But there's still incredible equity appreciation available there as EBITDA continues to grow over time as well, continuing to invest, do more acquisitions, whatever it might be, fueling organic growth, which Scott will speak to. Um, all of those things will continue to drive EBITDA, even if that multiple stays the same. But then in contrast, thinking about a firm that is still growing, and maybe they're a mid-teens EBITDA multiple. So there's of course both lots of room on the EBITDA multiple itself and the EBITDA as it grows. So and thinking back on the drivers of where EBITDA multiples can be for a certain level, it's all based on their organic growth trend and what margins they are at. And there's just a lot of opportunities to continue to drive equity appreciation.
So sellers are obviously the ones that are interested in rolling a portion of their equity into the buyer's equity, buyer stock. Okay. They're evaluating, like, what's my upside here? Like, what's the potential for growth? And Jacqueline pointed out there's two main drivers. Like, there's the multiple that's applied to EBITDA, and then there's the EBITDA itself. And so one would expect that the larger firms, like a Hightower, they're already at the top of the mountain, so to speak, on the multiple side. And so if that were the only source of return, then you would logically conclude that I would be better off rolling my equity into the smaller firm that hasn't yet hit that expansion of EBITDA, right? But that's not the only driver in terms of what's driving your value as a shareholder. It's the EBITDA multiple, but it's also the growth itself. And so while a Hightower and any number of other larger national firms, they have achieved those really high EBITDA multiples, also their organic and inorganic growth combined is 20, 30% or greater in many cases. So even though you might have reached the peak on the multiple itself, their ability to grow EBITDA itself is fantastic. And so even at those larger firms, the opportunity for shareholder growth is remarkable given what they do to drive EBITDA growth. Now, so think of it like a large cap, small cap play, right? So the small cap stock would be the smaller firms that are early into their life cycle. They have yet to hit those EBITDA multiple expansion gates. And so you have the opportunity for both, right? So you would conclude that there's probably more upside in the small cap stock or the firm that's earlier in their upside because you have the opportunity to appreciate your multiple to expand as the firm grows. So they go from a 12x to 15 to 18 to 20 and so forth. So you get the benefit of that. But you also get the benefit of the growth of earnings itself. So whether that firm is growing by acquisitions, that's adding to their EBITDA, whether they're growing organically or both, that's all driving the EBITDA number itself. The question is, what is the risk in taking that bet? And like a small cap stock, they're more volatile, right? So a firm that's at that $5 billion range is just, in theory, a riskier proposition than the firm that's at 100 billion, 300 billion, right? And so that's the basic math. And there are pros and cons that come along with that. So it's evaluating all of these three things: the expansion of resources and capabilities, ability to have a seat at the table, and where do you join on with the equity role in kind of conjunction with one another. And this has to be teased out from the seller to understand the pros and cons of each one and to be able to really land on what your ideal is in all these areas. And that's going to point you to where you should focus on buyers wherever they are in their life cycle. And we've obviously painted the ones in the early phase and the one on the mature not the end, but the mature phase. There's a whole host of range in the middle, right? And so we just have to pick the best. But this is just a way of differentiating buyers amongst four broad categories. And I'm not here to endorse the ones that are early or the ones that are mature. I think they're both fantastic, plus the ones in the middle. It's just what's important to you and where are you willing to roll your equity, bearing the risk and the potential rewards.
Yeah. Well, and I would say too, it's completely appropriate. Like if you're a seller, you're taking a portion of your valuation in the buyer's equity, very common, right? At the LOI stage and when you're going through purchase agreements, it's completely appropriate to be asking for their latest financials, understand their leverage ratio, what kind of debt is out there, have them walk through their forecast for the next few years and really feel solid about the business plan. I mean, maybe it's worth it just to help put a frame around the risk tolerance that you have of what type of equity you're taking to really understand more of that. And that's completely typical to ask for. You should be provided that, if you're asking for those things and they're not being provided to you, that's a red flag.
Quick question. You mentioned leverage ratio. Just for our listeners, can you quickly opine on what that means, what that indicates?
Sure. So that's the amount of debt that a firm has taken on and compared to their assets and their profitability that they have today. So their ability to repay debt, like if they were to see there's a big downturn and not be able to service their debt, to understand how close they are to, if something went bump in the night, we have a rough period, to be able to do that. Yeah.
Well, this third topic, it's funny whether you're over here on the left or over here on the right, and we've left out a lot of buyers in between. But just so I'm hearing you clearly, no matter which way you go, organic growth seems to be like the MVP of this conversation. Like no matter which way you go, the growth, the organic growth that happens post close seems to be what's driving this conversation.
Well, it was grabbing it from the buyer's perspective, like as we've talked about in another episode, like where do buyers like there's other reasons to do transactions. It's not all about the money, despite what a lot of people think. But from a financial perspective, where the buyers make their return is in watching the firms that they've acquired grow, period. There is a return component associated with the cash flow they bought and the delta between their valuation and the seller's valuation. That's not substantial enough to encourage them to do acquisitions. What does encourage them is their belief, whether it's evidenced by the historic growth rate of the seller coming in or their ability to clear the decks operationally, create capacity, surround them with resources and opportunity, and then drive organic growth. Hopefully both points them towards the direction that, hey, we are going to see this firm grow from 3 million in revenue to 6 million in 3 years or so. That's what gets them excited.
Well, you know what gets me excited? When we get to listen to people other than ourselves talk about the business, the experts in their field and where they are in their journey. And we've got a great couple interviews. We're going to start with CJ Rendic, the CEO of Parallel, and where they are on their journey. And he certainly falls under the category of one of the buyer models that we spoke to. So let's cut away to Alan, to the visit you had with CJ.
CJ, welcome to the Buyer's Boardroom.
Thanks, Alan. Great to catch up with you again. I appreciate you having me on.
Yeah, well, this will be a great interview. As you know, in the Buyer's Boardroom, we're trying to give sellers sort of like this inside peek at how buyers think. There's a lot of misunderstandings, frankly, some myths that exist, and we try to dispel those. But today we're going to focus on we call it life cycle differences. And that is this concept of there are buyers who are at different points in their journey, and the pros and cons that perhaps a seller might consider when faced with, okay, these are two firms, radically different sizes and histories, and let's evaluate them. So that's sort of what I want to talk to you about. Before I would do so, why don't we take a couple minutes, and I'd love to hear about Parallel.
Yeah, so Parallel Advisors, we're a pure wealth management firm, no asset management, so no proprietary product. I founded the firm back in 2006, so we've been at this now for almost 18 years. Hard to believe. We're fee only, discretionary, and we have added a lot of other services as we've grown. So we're at about $7.5 billion in AUM. We're a fast growing firm. Our target growth rate is 30 to 40% per year. That's what we're trying to achieve. Some of it through M&A and inorganic, recruiting, things like that. And, and a lot of it through organic, helping our advisors grow. So we do prepare tax returns for clients. We do family office services. And we are starting a trust company, which we're in the process of hopefully, having it up and running here in the second half of this year. And we're continually looking for how do we add value, to our end clients? How do we add value and resources to our advisors to help them grow? So we've got a little bit over 100 employees, 7 offices around the country, and again, always looking for high caliber, great people to add to the team.
Perfect. Well, congratulations on your success. We were just discussing before we started recording. The last time you and I spoke, you were a little over 6 billion, so 7.5 billion, and that's probably in the last 18 months, I would think. So fantastic growth. Congratulations on that. It's amazing.
Thank you.
So, okay, the first point that we want to discuss is access to resources, either for clients or for the team members. And the basic concept here, CJ, is like one would naturally conclude, and it might not be true, but they would naturally conclude that larger firms have more stuff than a smaller firm. Um, and obviously, you're starting to add new services. You mentioned tax preparation, so that's one that I think is a fantastic add beyond traditional financial planning and portfolio management. You have a trust company coming online later part of the year, so clearly you think that's important. But maybe talk about how you think about your role as a partner in terms of creating or delivering an expansion of services and capabilities to your team.
Yeah. Yeah. So it's been interesting, and having the benefit of, starting parallel on my own out of my house. I've sort of seen the evolution and the sort of the growth cycle, if you will, the life stage, as you call it, of the firm. And what happens is clients are constantly asking for, us to do more and more, right? And you have to get to a certain critical mass or a certain size to be able to have the money to invest to start adding, these services. And so in the early days, I got to be honest, I kept the blinders on. And when we had a small team and we were a small sort of specialized wealth management firm, we kept the blinders on, even though we were being asked to be corporate trustee for clients. They wanted us to do taxes. They wanted us to do, more advanced reporting or bookkeeping or bill pay for clients. We really didn't have the bandwidth, and the resources to hire people to actually do that. So I agree that there is definitely a critical mass that's important to get to because, the big firms out in our industry are doing these things, and to be competitive at that level, it's important to do it, or else clients may go somewhere else. Because my opinion is clients really are looking for that sort of one-stop shop. Can you guys handle all my financial needs and my planning, and are you going to be around with me, through my entire life, basically? So
Yeah, well, I certainly see it as a trend, and naturally, as you guys are getting larger, your capabilities to deliver more services, let's say, are increasing. And what you can do now at 7.5 billion likely wasn't available to you at 2 billion. And so I think that's very important. But I think one thing that I want to point out, and you tell me if this is true or not, it's as you are looking to add new services, so we've already done tax prep and corporate trustee. Is that something you look for in a prospective partner via acquisition? If they can bring something to the team or to the table that you could take then and roll out nationwide?
the short answer is yes. If there's additional skill sets that can be additive to the firm that we can, leverage across all of our advisors and our clients, that would be great. And there might be, special expertise in a certain target client, that's constantly we're looking for that. But as you get bigger, those opportunities, are kind of, fewer and farther between because we're already doing a lot of these things. For us, I think the critical mass number was at about 5 billion in AUM. That's where we, started, looking outside of just purely planning and asset allocation and started doing things like tax and, started bringing on bigger clients and things like that. So
I'm glad you said niche expertise because expanding, we say expanding resources and services. So the resource might not be a full on service per se, like tax prep, but it could be someone who has domain expertise in a specific area, like perhaps advanced estate planning or, exit planning or, something that would be relevant as a a subject matter expert on the parallel team that other people can leverage.
That's right. It can even be they work with a lot of dentists, for example, and there's specific needs that dentists need that others don't, you know. So that is always welcome. I mean, we have a very collaborative way of operating. In fact, we have these advisor forum structures where advisors are in these little groups of other advisors where they share knowledge and they help each other out. And then we try to expand that out to the entire firm. So we're always looking for new, areas of expertise, of ideas that people are looking to contribute to the firm.
Got it. Got it. Okay. Well, that's a good segue to the next area that I frankly think, if you look at all these points, access to more resources, seat at the table, maybe the equity story, this next topic, seat at the table. Often we have sellers that come to us and they tell us that, look, I want to be contributing or contributive to the build of the organization. They have different ways of defining that, perhaps, but certainly you would think um, that opportunity exists in the smaller firm, and I'm doing air quotes in the smaller firm. 7.5 billion is quite a sizable firm, but contrast it to $150 billion practice. Perhaps you might have more opportunities or seeking more collaboration, contribution from that partner who would say, "Hey, I would be interested to potentially join Parallel, but I got to know that you're going to be valuing my input and seeking and maybe in a leadership role or some other type of role." So maybe talk how you think about that, and what opportunities are you seeking today at Parallel?
Yeah, and look, there's no all these things that you're talking about. It's not really what my experience has been. It's not black or white, right? There's these polarities that you need to manage as you get bigger. Clearly you want we want input, we want participation from advisors, but as you get bigger, there's just more voices around the table. So all these things are like, how do we manage this so that we can get the best knowledge, for the firm? So it's not typically a yes we do it or we don't do it. It's like, how do we do it, and then how do you manage it, as you kind of go along that spectrum.
Yeah, I want to say one thing here because I don't want you to misunderstand my point there. When I speak about a seat at the table or being collaborative, I'm assuming that doesn't mean like they have voting control or like, and that's what I think. If I'm reading the tea leaves you were speaking about, you can't have 50 people who are tasked with making the vote on any critical item because it'll take forever to get anything done. So that's not what I'm asking about. So
I wasn't implying that necessarily in terms of decision making. It's more about seat at the table in terms of providing input, being involved in flushing out ideas as we grow. So, and I'll give you a great example, and this might clarify it a little bit. So, we have, of a firm of about a little bit over 100 people. We've got, I believe it's somewhere around 25, partners or principals, and larger advisors, especially that join the firm, they would be part of this principal group. We have a principals meeting every month where we basically, share all the initiatives, the results, financial results, all the stuff that we're talking at our formal board meetings with our board members, and we put it out there to this group of principals to try and get feedback and answer questions. And did we miss anything? And so it's like this more of an ideation.
well, they have a voice. It sounds like they have a voice. You're going to take their input. You're not managing Parallel, from the corporate office,
Right.
dictating things without advisor input to what's happening.
Right. It's exactly right. And we also have things like committees that advisors can participate on, investment committees, marketing committees, things like that. So we, the nature, the spirit of how we operate is very collaborative, and we're constantly looking for feedback, and we're very transparent. I always like to say that one of my flaws is probably I'm too transparent, but I'd rather operate, in that manner than not being transparent enough.
So let's tackle the final topic here. And my guess is you might disagree with how I frame this, but we'll see. So it's the equity story. Okay. So I know you're interested to have equity partners at Parallel, and that's a great indicator that a seller in this scenario, which is not equal to exiting the business in the vast majority of transactions, they're becoming a part of their team, and in the transaction there'll be a valuation, and a part of that valuation is going to be rolled into equity of Parallel. Okay, and so um, we call this the equity story, and that's essentially really evaluating the potential return versus the risk in owning, in this scenario, parallel equity. And you could contrast that with a larger $100 billion plus firm. One could easily make the initial statement that, okay, the larger firm may be more stable, less risky, kind of like a large cap stock to a mid cap, small cap stock kind of scenario. Um, but the alternate counterpoint would be, okay, there's maybe potentially more upside in joining a firm at the $7.5 billion size as you are on your journey to 100 billion, and that makes total sense. So I just threw a couple of things out there. Do you agree with that generally? How do you think about the equity story of Parallel?
Yeah, I absolutely agree with that. And I would kind of break it down as most of the firms in the industry are micro cap. And I would say we're sort of a small to mid cap, and then there's these large cap firms, and then you've got sort of large cap value and maybe some large cap growth firms. But I absolutely agree with that. And again, back to the critical mass story, I think there's a point where you do sort of de-risk a lot by getting to a certain size, and then there's other things that you can do to de-risk. For example, we brought on a private equity investor at the end of 2022. So Golden Gate Capital is our backer, and partnering with a long term view capital provider like that can also de-risk because they've got access to to be able to fund our balance sheet and knowledge and partnerships and things like that.
Certainly, as validation of the firm that you've built. When someone is willing to write a check for it, that's the best marker of value.
That's right. And there are nice things like, if somebody retires from the firm, so people, the shareholders, and we have, I think about half of the folks at the firm are shareholders. We're not all waiting around for liquidity events, or our shareholders are not waiting around for liquidity events. When they retire, we actually buy back the shares, and we do this with our partnership, with our private equity partner.
So there's an internal valuation mechanism to handle an exiting person, let's say, that wants to redeem their shares.
Yeah, that's right. And I fully believe what you said earlier is right. And I again, I'm biased, but I feel like we're in that sweet spot of we're like big enough to where we've de-risked, but yet we've got a lot more to do and a lot more to go. At 7.5 billion, we'd love to be $100 billion, AUM firm. And it's kind of like the challenge with getting bigger is keeping those 30 to 40% growth rates going is tougher the bigger you get, especially when you're talking about M&A, where the deal size are they're not increasing necessarily. So you're having to do a lot more deals, and what can you absorb and what can you integrate, effectively. And so I think that there's a lot more upside at 7.5 billion than there is, maybe when we get to 100 billion in AUM.
I agree. And the other party, which is Hightower, that we interviewed in this specific segment, Scott Holsopple made a great point. He's like, Alan, a $10 billion firm 10 years ago was considered large. He's like, today it's not considered large. And so I think there's substantial runway at 7.5 billion. I mean, like, just my gosh, I think it's what would you say, mid cap, or like a growth oriented mid cap, let's say.
Yeah, SMID. Maybe we'll go with SMID growth. But there is a lot of opportunity. I definitely agree. With the sentiment that the firms are getting bigger in our space. There's no reason why eventually we couldn't have $1 trillion.
Oh, of course. Yeah, we see that coming. And well, okay. Well, fantastic, CJ. Thank you very much for your time. I love your insights as always. We appreciate you taking time out of your day to spend with us at the Buyer's Boardroom, and certainly appreciate the partnership with Alaris, and look forward to working with you for many years to come. Hopefully we're a big part of that 7.5 billion to $100 billion.
Absolutely. You're a key part of that, Alan. So I appreciate you having me on, and thanks for the partnership.
All right. Cheers.
Well, moving right along, Alan, another great interview, but we're not done. As I said, the booking agent's been hard at work. We're going to talk with Scott Holsopple. And here's a buyer that is a little farther along on their journey with $100 billion in assets under management. Why don't we cut away to your visit with them?
Scott, welcome to the Buyer's Boardroom.
Thanks for having me. Looking forward to the conversation.
Congratulations. You guys have
Thank
built one of the preeminent, certainly one of the most recognizable names in the industry in general, but also specific to acquisitions. So why don't you take just a quick minute and introduce yourself?
Yeah, so Scott Holsopple, as you mentioned, I'm Chief Growth Officer at Hightower Advisors. Hightower Advisors is about $150 billion or so of collective assets spread across 130, 135 advisor businesses. And I think that, and you've alluded to it, is a pretty core part of our story, which is, and why I think we're still a nimble actor in this space is we're not looking to be one experience. I think what we're looking to do is meld the benefits of a national scaled player with really the kind of the differentiation of these local businesses that have been built over 10, 20, 30 years, are part of the community, are unique in what they do, but can benefit from aligning themselves with a partner who enable them to do more things for their clients than they'll do on their own. So over the last 4 years, I think we've done around 40 acquisitions, ranging from everything from smaller independent boutique, $100-200 million in net total assets, to our largest acquisition was around $10 billion in total assets.
I certainly appreciate that. And for those listening, 40 in the last 4 years has to put you at the top of the list in terms of number of acquisitions, which clearly means that you have you've mastered the skill of telling the Hightower story, integrating firms into the Hightower brand. And so kudos to you on that. That's just fantastic results.
Appreciate it. I would say we've learned on every one of those. And I think we have the ethos of you're always trying to and aspiring to be better at the next one. So our story has evolved as I think you'll hear in today's conversation, and how we even think about integrating businesses has changed quite a bit too.
Great. Okay. So we are talking about the life cycle differences of a buyer, and just two ends of the spectrum. A firm like a Hightower, 150 billion in assets. And then on the other end of the spectrum is the firm that's just getting started, maybe has done an acquisition, maybe they haven't. They both present two very different realities, different opportunities, maybe different constraints, in their respective models. So we're going to talk about that. The first area that I want to ask you is on this, my opinion, that the larger firms, and this is common sense, should have more stuff, right? And by stuff, I mean, it could be technology, it could be operational support, it could be organic growth drivers, it's certainly people and expertise, expansion of services, all of these things. So maybe talk about Hightower, where you sit. If you consider that the most of the industry is doing financial planning and portfolio management, those are the two bedrock services. How do you support your advisors? Talk about all the stuff that you guys have, I guess.
Yeah, it's a great place to start. So the growth, or Hightower has, I think call it 500 or 600 advisors within, across 130 firms. And within corporate, we have about 300 people, a little less. Of those, call it 280, 300 people, about 60 of them are dedicated to working with our firms and growing the firms, either helping them run what we think of as an operating model that we know produces above average growth, or the service model, so extending what our advisors are able to do for their clients. And I think you're right. I think as the size of the firm grows, and I think the expectations for what they're able to do for a client should grow as well. And I think this is one of the big changes over the last couple of years. where, when I joined Hightower 4 years ago, is what can we take off your plate, right? So compliance, managing technology environment, the financials, billing, things like that. That's what resonated with sellers and partners. Now that's kind of a prereq. Like, that's what you have to
table
have.
stakes. Yeah.
Yeah, exactly. That's what you have to have to get into the conversation. And more, it's about like, what are you going to enable me to do for our clients? So, how are you going to help me do alternatives in a way that I can't do myself? Do you have a national trust company? Do you have the ability to review and help refine estate planning docs? Do you have tax and bill pay services and the family office experience for those types of clients? And so I think when we started hearing this on the M&A side, it kind of dovetailed in what we were doing for our advisors, but what really pushed us to accelerate that push. So we do have a national trust company that's available to all of our advisors, and really is structured in a way that brings the advisor into the conversation, rather than like, hey, they're now trust assets and they're over here and you can't really do anything with them. Last year, in the middle of the year, we bought a CPA firm that works with business owners as well as individuals, because a lot of our clients are business owners. They have growing, thriving businesses, and that's a piece of their story, and an important piece in many regards. So having a firm that can sit alongside of them on both the business and the personal side was really important for us to find. And over the last couple of years, we've built out an estate and financial planning team. So, when somebody has a complex estate plan, we have a team that can sit with the advisor and the client and walk them through, what does the estate plan do? Like, what would be some of our suggestions? And in many cases, it's been extremely valuable to the client and helping them rethink, what they want to accomplish with their estate plan. So those are just a few things that I think we're able to do for our advisors, because we're able to invest at a scale that, $1 billion, $2 billion firm just can't financially.
Yeah. And I think that certainly from our perspective at Alaris, when we have a firm that is coming to us and, we're inquiring what their partnership preferences might look like and what things that they would be seeking in terms of, helping their quality of life, the advisor experience improve, as well as help me look better to clients, make me more attractive to clients. Those 2 points alone point them to the larger firm, the larger partner who's got all of those resources, plug and play. Instantly, you're in the part of the Hightower partnership. You have access to all of the things, and these are not third party. It's their team, right? And so instantly they're on the Hightower team, and they have a upgrade of magnitude along those lines. There's a lot of those things that obviously we'd like to have, but Scott, we have a desire to contribute. Now, we might be bringing something valuable that we think a firm could take and leverage and scale. We want to be involved in decision-making processes, contributive, in other words, to the build. At 150 billion, are you still looking for people like that? Or is it more, we've already got that figured out, guys. We don't need you to invent new things. Just come in right in and plug and play with what we've built. When someone asks, I'm sure you get those types of questions.
I think we're much more of the first part, which is like, we're looking for people to add to Hightower. And I would say, I think about this as less, is it smaller versus bigger? And I think it more about the personalities in the business. Because I'll tell you what, I've met $2 billion firms with leaders that would be like, no, you're going to do it my way, right? And I've met leaders of $100+ billion firms that their goal is to get better every day. And so they're, of course, open to the ideas of the folks that are in their community. And I recognize it in a couple of ways at Hightower. So 3 of our board members are advisors. So they have an active voice at the board level, right? We have a group called it's over the Hightower experience that we provide to our advisors. There's 12 firms that are represented over that, and it rotates on an annual basis. And so we are actively looking for their advice and their influence in how we are serving them, but also what are we building for them. So we didn't, I mentioned a national trust company and state and financial planning desk, a CPA firm. Those weren't our ideas. Those were the ideas of the firms that are part of Hightower, because they're saying, hey, like on a daily basis, I'm getting asked about this by my clients, or I'm competing with folks that are able to do this. We need to be able to do this as well. So it's really about us going out and solving problems that we know our businesses have and enabling them to do that. And I think the second way, or another way I'd show the difference is, we're not Hightower advisors. Like, yes, there are people that are branded Hightower, but you can also go and look at Lexington Wealth Management, Greensboro Wealth Management, Bel Air, Lord Murray, and then on and on.
You're not requiring a divestiture of brand.
That's right. And so really it's a celebration of that uniqueness. And if it just stopped at brand, like we wouldn't be fulfilling that goal. And so I'd say there's an active feedback loop all the way from the top, the board level, through the day-to-day. What are we doing? And then when I mentioned there's 60 people within the growth team, part of that is what we call advisor engagement, and those are like kind of the business strategists and the people that sit alongside of the folks building their businesses. So we're getting feedback on a daily basis, including me. People aren't afraid to like email you and let you know what's going right, what's going wrong.
Yeah.
And that gives you just that really tactile feel of what's going on in the business.
The access to resources, infrastructure, expertise, that is a likely byproduct of being a part of a larger firm.
Yeah.
Even though there are some large firms who might not offer those things, but you would expect that would be true. However, the collaborative environment, the willingness to seek out input from partners, the willingness to adopt other advisors who bring something unique to the table, that's really not a function of the size of the firm. That's a function of the leadership and the culture. And as to your point, you can have a $2 billion firm that's quite our way or the highway.
Yeah.
And we're not interested in input. We've already got it figured out. In a firm like Hightower at 150 billion, who's saying, no, we actually do want your input. We've structured our business to give you multiple points of input.
Yeah.
We have people that are there to help make sure we're seeking out our advisors' input as in terms of how we're shaping the business. So
I think that's right. And I also think that look, do you probably have a more defined experience as you get to be a larger firm? Yes, because to your point, like on M&A, we've told our story so many times that we will find it over and over again because we've had the opportunity to do that. So I think the story is probably more likely to be defined as you grow. But these businesses are still very personality driven. And so I think you can find a big firm that wants to collaborate. I think you can find a small firm that doesn't. And I think you can do vice versa, right?
Yeah.
I think there are big firms that are like, no, this is exactly how you're going to do everything.
Yeah, I know that's true. So I agree with that 100%. We have, and look, I'm not here to say it's right or wrong, because the people who argue for do it our way typically have really good data or reasons why they want you to adopt it.
Exactly.
And so it's just, what are you looking for as a seller in this scenario in terms of life on the other side? Do you want to just plug and play, not really be asked to contribute much or do much in that regard, or a collaborative nature?
Okay. I think that's a really key point. I mean, there's something like 40 private equity backed RIAs.
Yeah.
Like as a seller looking for a partner, you've got choice. It's like, what are you looking to solve for?
Absolutely. Okay. All right. Now this is sort of like a gotcha question that I'm going to throw at you this time, because we get asked this quite a bit. I believe I know the answer, but I want to hear your reaction to it. Okay. So part of this deal typically is going to be involving sort of an equity rollover. There's a valuation done on my business. Either you're not going to acquire 100% of it, and so I'm left with a percentage of my current business that you may be the buyer for later, or you do acquire 100% of it and I roll it into, let's say, Hightower equity.
Yeah.
You guys have, we know the EBITDA, the larger it gets, the more the multiple applied to it and all that. So haven't you guys, is the juice all squeezed out of this equity story at Hightower? Because at 150 billion, I don't know what you guys would trade for, but it's probably more than me You know, if I'm at a $2 to $3 million revenue firm, and if I'm being asked to take equity in Hightower, I want, a big upside. And that seems like maybe the smaller firm has a better story there that we haven't hit those. So, but I want to hear your answer to that.
Sure. I think of it in context of two things. One is the market, and the second is risk reward. So I'll start with market. If we were in and I think some of this story is like over the last couple of years, $100+ billion firms have been built. Now it feels big,
Sure.
but we're in a multi-trillion-dollar market, right? And so it's
the $100 billion firm is just like a bump on the.
That's right. And I think that will be recognized over the coming years, because we'll soon be talking about $1 trillion kind of wealth business, right? And so, that is multiples bigger than what we are right now. And so I think it's somewhat because like we do stand out among others that have crossed that $100 billion mark as notable in the industry. In 5 years, I don't think it's going to be notable, which means this.
To your point, I remember 5 years ago, a $10 billion firm or $20 billion firm was considered large. And today I consider those like just getting started. Like they've done some organic growth and they're not nearly what I thought of them 5 to 10 years ago.
That's right. I mean, 10 years ago when I started really kind of investing in RIAs, had left an executive team of about an $8 to $10 billion RIA. It was like one of the largest. $1 billion firm was considered big, right? Now $1 billion firm is like, just the starting point. To your point, a $10 billion firm is a starting point. So I think of it as this just massive market opportunity. There's 14,000 RIAs. The vast majority are below 150 million, but still so much room to run. There's, even when we're talking about like, the record numbers of transactions, we're still talking 200, 250 transactions, maybe.
Yeah, and despite all of the record M&A, the number of RIAs has grown.
That's right. That's right. So we're
okay. That's a great point. Then, so relatively, 150 billion is likely, and I agree 100% that in 5 years that's not going to be considered anything abnormal. And so still a lot of runway on that aspect is your point.
So where do we stop? 500 trillion? I don't know, but like there's so much room to run because of not only the M&A opportunity, but just the client opportunity, the wealth that's being created across the generations, the rotation to independent advice from I'll call it the brokerage model, is going to continue to add to this. So I think there's just massive opportunity in the market. And then I think you go to the second piece, which is risk reward, right? I can't tell you where the highest return possible, because it really comes down to, for any of us, how do we execute on the opportunity? Mm-hmm. And then what role are you going to have within the execution of that opportunity? And so, look, like if you're a $5 billion firm and you're considering Hightower or another, large scale buyer, and you're considering merging with another $5 billion firm, you may have opportunities in that firm that you probably won't have within Hightower. Like you might be, if you're the CEO of the $5 billion firm, you're one of two people that probably are most likely to be the CEO of that firm. You're probably not going to be the CEO of Hightower, right? Mm-hmm. And so I think there are differences, but I think this market is so big that it really comes down to who executes the best to take advantage of the opportunity in front of us that is undeniable. Mm-hmm. And then it's like, we're all like, there's ways for us, for many of us, to win, right? And create substantial value for our shareholders. And so in any of these conversations, I often start with like, pick the best solution for you. Yeah. Because if you pick the best solution for you, you're going to create value and wealth for yourself. And I'm not going to tell you which one's going to produce the most, because I don't know. But if you're passionate about going to work, if you're passionate about creating value, the likelihood of you winning is higher than if you just focus on like, what is the highest potential return opportunity.
I agree. And that's what you're seeking in terms of the shareholder, I would assume, is someone who understands that and is focused on that If we all are focused on that, the economics are going to take care of themselves. I would, to your risk return concept though, I do think this makes sense. You know, like a firm like a Hightower, you know, that's well ran, you know, that is a more stable asset to own than potentially the smaller firm. So there is that aspect of it. And there are a lot of sellers who, that's if they're going to exchange equity into some other entity, they want like to move towards stability. They still want some upside, but they would like to know that, hey, this isn't like a small cap stock, you know, so to speak, you know. But
I agree, and you're right. I didn't really expound on that. Like I think that there are, you know, just broadly investing in general, like risk reward tends to go together, right? And so I think there's an element of that here. I just think it's not as like simple as that. In that, like, you know, could a firm that trades at a X multiple trade at a higher multiple, and therefore it's easier to like make money? Like, yes, if you're able to continue to grow organically, if you're able to execute on an inorganic strategy, if you're able to
well, you know,
extend your value proposition.
The $2 to $5 billion firm, given where they are, they're going to have to make substantial capital investments and execute and do all the things to get to the size you are. And I'm sure you're here to tell everyone that going from 5 billion to 150 billion is no easy task.
No, I mean, going from 100 to 150 billion is an easy task. I mean, we learn every day, right? There's things that we can do better every day. And so, you know, it's that commitment and capability to invest at a scale and at a pace, you know, that others just can't.
Yeah. Got it. Well, awesome. Well, Scott, this has been fantastic. You hit on all the points that we wanted to cover eloquently, articulately. And so we very much appreciate you being a part of the Alaris roster and willing to spend time on the buyer's boardroom. Can't think of a better partner for firms seeking a transaction than Hightower. Once again, just thank you so much for the time.
I appreciate the opportunity and really enjoy the conversation. So,
okay,
thanks again.
Cheers.
Have a good one.
Well, once again, Alan, great interviews, great people. It's so nice that people actually take their time, they're out of their busy day to spend time with us. And for those of you joining us, if you want to be on our show, we'd love to have you. We want content and industry experts on our show visiting with us to add substance to what we believe we're masters at. But it's always nice to have experts in the industry to add their time and their know-how. Now, my favorite part of the day, we have the buyer's boardroom mailbag. So for those of you who have content, you have questions, you're afraid to raise your hand in public because you don't want to be picked on, emailing us at boardroom@alarisacquisitions.com. That's boardroom@alarisacquisitions.com, and we will take your question on the air. We do have one today. It's kind of funny, the timing on this, because of, you know, what we were talking about on the front end of our show with some of our tech and some of the things that we're rolling out. But we've got someone here, a loyal listener. Hi, team. I'm enjoying these podcasts. Every year I get a valuation on my firm for what I suppose is a competitor of yours. I input some items and then a valuation comes out on the other side. Now I realize nothing is that simple. What I do wonder is, after listening to all the other things that go into a valuation on your show, I worry about the accuracy. How close are these quick valuations to the real thing, in your opinion? That's a hell of a question, guys. Because there's people out there that are doing pretty well by this.
Right. There's things that are out there today that you can plug in basic data on your business, revenues, expenses, owner's comp, things like that. And it's very easy to look at an EBITDA number or whatever falls out of that mathematical equation, whatever their calculator is providing for, and then apply a multiple to that. You know, that there are basic ranges today, and this gradually shifts, ebbs and flows over time, but EBITDA multiples ranges are applied in pretty consistent fashion. So it's not hard to tell me what your EBITDA number is or have me calculate it, and then just give you a number that would be applied to that to, you know, equate to a valuation. However, yes, the devil is in the details. There is so much that goes into the range. So typically, if you look at any number or any dollar amount of EBITDA, we usually quote like a 3 delta range. So like so let's say it was $1 million of EBITDA. I would likely tell you that that's going to trade for 7 to 9 times, today, as we sit here in early 2024. But so there's obviously, well, what puts me on one end of the range versus another, right? That 3 delta difference is massive. And so the things that go into that are a combination of qualitative and quantitative factors that are specific to your business and specific to the buyer's business. And so I would tell you, even with our own calculator, while it's directionally accurate, you cannot rely on that as a, take it to the bank type valuation of what you should expect. We need to go through a whole host of other discovery factors with you to be able to give you an accurate number. It could be lower or higher than what the calculator implies. Further, the valuation is one component of the deal. There is the deal terms. How is the valuation paid to you? Right? That could be impacted by a number of qualitative and quantitative things.
That's not going to show in a calculator.
It's not going to show on a calculator. Exactly. And Jacqueline, one thing that frustrates the hell out of me is that all we ever talk about is what is the valuation of my current business? Well, that's obviously important. But to me, what's equally important is after the transaction, what does my economics look like then?
Right.
Particularly if I rolled equity, we just spent a lot of time talking about equity rollover and the different firms you could roll into based on their life cycle. But you've seen the equity component of the valuation that they took 20%, 30%, 40% be worth more than the entire deal just 3, 4, 5 years later.
Right.
But very few people ever talk about that. Very few people ever talk about what's my ongoing share of economics in this deal.
Like in the
post-acquisition.
compensation as the business
Yeah,
grows,
absolutely.
what does that look like? Right.
Absolutely. I mean, that's if you're going to be around for 3, 5, 10 years after the transaction, that's equally as important as what is the current valuation of your business. Is there an earnout associated with this transaction? That's additional valuation beyond my current business. So to your point, sorry to be long-winded on that answer, Rick, but valuation calculators, even valuations done by a professional, and like God bless them, the ones that spit out market comps, discounted cash flow models. Jacqueline, we've done collectively 100 some odd transactions. Have we ever seen a buyer use a discounted cash flow model or a market comp in terms of valuing their business? I haven't. It's always a multiple of EBITDA or some
Right.
type of multiple applied to either EBOC, EBITDA, or gross revenue.
Sure. Well, for the version that's shown to a seller, certainly. I mean, sometimes like behind the scenes for their own math or if like raising capital, I think to triangulate on what is an appropriate amount. But the tough part is there aren't a lot of course, public market comps for the
Yeah.
transactions below 50 million, let's call it. There's not a lot of public activity there. So you're relying on what is the latest current information from folks that are really active in the space. And to Alan's point about, yes, there may be a range that's reasonable, but there could be things in your business that could drive it way higher or not have a market for your business at all, depending on certain
Exactly.
things. And
I won't name them by name, but I saw it's been the last 6 months, one of the leading M&A sell-side advisory firms in the country put in an article a quote that they got for a firm that I think had 300 million in assets. They said they got a 17x multiple for that business. Okay, maybe you did and maybe you didn't, but that statement in of itself is so loaded with embedded assumptions. I promise you, without knowing anything, if that was a kind of traditional wealth management business, zero chance that firm actually got a 17x multiple on the current business.
right.
Now, maybe they had some kind of technology associated with it that inflated the multiple. I doubt it, but they said it. What they're probably referencing is they got a much lower multiple on the current business and had some super aggressive growth earnout associated with it. So my guess is that business probably got a 10x on the actual business and maybe had, some growth hurdles that they had to hit, that if they hit those super aggressive growth hurdles would deliver another, 7x turn. I even doubt that.
Right.
My guess is they monkeyed with the P&L a bit, and created a fictitious 17x multiple. It's those types of things that drive us nuts. We're way beyond your question of valuation, calculator accuracy, but
This is what we want people to hear. Like, even if you go to ours, like, yeah, this is telling as of today with minimal time spent, but it could be
they're
positive or
useful
negative.
and they're cool tools, but
Yeah.
you got to really get in the details.
Agreed.
Well, guys, we're going to wrap up part 2 of this mini-series. I'm loving this, guys. For those of you with us, we're in a 4-part mini-series that's basically focusing on how we differentiate between buyer models. What have we covered so far? We've covered structural differences. We spent a great hour of time on structural differences between buyers when deciding which way you're going to go. Today, we talked about the life cycle. Where is that buyer on their journey? And how is that readily applicable to what the decisions you're going to make? Our next one, we're going to talk about autonomy. This is a big one. On every phone call I have, it's, are they going to leave me alone? What's my life going to look like? I don't want to be chained to my desk and all the other things that come with that. So I'm really excited for the next episode. Our booking agent, I'm sure, will be hard at work for who our guests are going to be. But that brings us to the end of episode 3 in this episode 2 in this 4-part series. We're going to finish with expansion of capabilities. This has been a great journey. This is for you, the potential seller. You could be miles away from wanting to transact, but that day is looming. These are the kind of days that you want to spend gathering as much information, hugging it, holding it close, so you can make the best decision for not only you, but your future partner. That's going to do it for another episode of the Buyer's Boardroom. Jacqueline, Alan, as always, love, respect, and we'll see you next time.
Thanks, Rick.
Awesome. Thanks, Rick.